Hi guys, you have heard in my earlier video about the business structures and the theory of the firm. In business structure, we have heard about the way in which the ownership structures and management structures. How do you start the business like sole trader, partnership, joint stock company, or not for profit organizations? We have discussed about it, and we have also discussed about the theory of the firm, wherein we identify four major components in business. Number one, how do you raise the revenue, and what are the costs involved? The costs include production function in case of a manufacturing firm or operations function in case of a service firm. And how do you link these four through the objective of the firm, wherein we have talked about profit maximization, output maximization, revenue maximization, satisficing theory, wealth maximization concepts. Now, let us look, in order to put everything in operation, in order to organize the capital and labor along with the structures, you need capital. So, what are the sources of capital? That's what we are going to learn today. The sources of capital, we mean where from you raise the finance. How do you raise the finance? You should first know the finance meaning. Finance is the lifeblood of the organization, because without finance nothing happens. So finance is required at every stage, starting from the business, from promotion to the liquidation. That means even if you want to close the company, you need money. In order to promote a company, of course you need money. Thus we need to know various sources through which we get funds. Why do you need finance? Basically, finance is needed for two important aspects. One is for the fixed capital requirement. Second is for the working capital requirement. The fixed capital requirement means we buy certain assets which are not meant for sale but for utilization. If you are running a computer based company, you need computers. If you are running a manufacturing firm, you need machines. And machines are to be located in a building, and it has to be supported by furniture, fittings. So all such things are purchased once and for all, maybe till their lifetime. The lifetime differs, of course. For a building, it may be hundreds of years or at least decades. Furniture could be a decade or 2 decades. Computer could be only 3 years or 5 years, depending upon your the mode of modifications, technological innovations. But even if it is for more than 3 years, still we call it as fixed capital, as long as you are not disposing it off within one financial year. If you are disposing it off within one financial year, it will not be called as fixed capital, it will be called as working capital. Anything that you dispose of in one financial year, normally we call it as part of the working capital. When we talk about the working capital, the exact meaning of the working capital is the capital that is needed for you to have operations. You need to have a flow of operations. The flow of operations may start with purchasing of raw material, processing it with the help of power and labor, or you supporting it, facilitating it through lighting, stationery, or the other simple supporting equipment, etc. And then finished goods have to be pushed. Logistics you have to manage. The logistics also could be part of the working capital. So this fixed capital and working capital, two are the separate items. In order to acquire the fixed capital, you need a large amount at one go. In case of working capital, you need a flow of capital continuously. That is the reason nowadays banks are giving loans for fixed capital as well as the working capital. So what are the such sources? Let us know about it. So when we talk about the fixed capital and working capital, we should also know that the factors which affect the choice of the source of funds. That means which source we should go, how much we should go, when we should go. All these things will depend upon these factors. Number one, cost. Cost of capital. That means how much price you pay to raise the finance. Suppose you go for a bank loan. The bank may charge as small as 8% if it is educative purpose. It could be 15% if it is a consumption purpose. It could be 20% if it is for a luxury purpose. It depends. So you need to pay interest on loan that you take from a bank, an external finance. Similarly, if you can make your friends trust you, you may be able to raise finance without paying any interest also, provided you give them share in the profits in future. So that is called cost. What is the price you are prepared to pay to raise finance? If you go to a money lender or a private financer, he may charge you 36% interest. You may get for immediate without any application to fill in. So how much you are prepared to pay? How much you are prepared to pay depends upon how much revenue you are expected to raise. If your revenue expected is extraordinarily high, you are prepared to pay high cost. A simple example I'll give you. The vegetable vendor in a market, when he goes to the market, the commission agent gives him 1,000 rupees today morning and he expects by evening 1,050 to get back. So 50 rupees on 1,000 rupees for one day could be the cost of capital. So all such things we call them as a cost. Then comes risk. When you take loan or when you raise money, how much risk is involved? If you are taking too much of loans, there is every danger that the lender will take over your company and you are thrown out. So that is a risk involved. If you have ownership, if the owner is not reliable owner, daily he will create problem to you, management, and thereby it is a daily nuisance for you. Having a partner who is not cooperative with you, that is also non-quantifiable risk that you are taking here. The purpose and time period. What is the purpose for which you are raising money and how much time you will pay back? Anybody whomever you ask money, they will ask two things. Number one, why do you need? Number two, when do you pay back? Number three, how do you pay back? These three will ask. So you need to answer these three. What is the purpose for which you are going? If it is an illegal purpose, nobody will give you loan. If you are saying that I will pay after 10 years or after 5 years, no one will pay you. And if you say I will pay you interest this much, that will maybe a motivation. Sometimes you also look, you will be able to get some tax benefits. For example, instead of raising capital through equity shares, if you raise some loan, that loan is chargeable to the profit and loss accounts. I think all of you are not commerce people, therefore you may not have idea about this, that in case you are able to raise finance without raise finance and pay interest, then that entire interest is debited to the profit and loss account. After deducting that expenditure from the profit, you will get lesser profit. That lesser profit will be the basis on which you pay the income tax. Whereas if you are issuing shares, you need to pay him dividends or you need to pay him share in the profits. Share in the profits cannot be shown as an expenditure in the profit and loss account, and thereby you cannot reduce the tax. So tax benefits permits you to go for debt loan rather than the share capital. There are some advantages and disadvantages to that. We need not go into that depth. But flexibility and ease, how easily we get. See, it is every danger that many of young boys like you will fall into the trap of app-based loans. The flexibility is so easy that if you take a loan, within seconds you will get through Google Pay, your money will be paid to you from by any Chinese-based app. But he will charge you very high rate of interest and very fast you have to pay back, and you will not be able to do so. In order to pay that, you take another app. Nowadays you must have seen, ultimately leading to the youngsters committing suicides. So flexibility can be that flexible. Or if you are taking a loan from a public sector, you have to fill up more forms, but it is secure loan. Like that, how much flexibility, that also influences the loan that you take. For example, when I have taken a personal loan. Instead of a bank, I preferred Sundaram Finance, because he came to my house, took every signature, and then he gave me 10 lakhs without questioning anything, and I started paying. So such flexibility always works. Financial strength and stability of operations. If you are financially sound enough and your ability of organization is good, people will come and ask you, we will give you loan. That is how you must have seen, where Nirav Modi or some others who could raise 1200 crores from a public sector bank. If you and I go for 10 lakhs also, they will ask so many questions. So financial strength of the firm gives an impression to the lenders that their money is safe. That gives an impression. So that is also a source. Form of an organization and legal status. If yours is a joint stock company, then you will have a wider choice to take loans. If it is a partnership firm, they will ask you the signature of every partner. So that is a form of organization will have. And effect on credit worthiness. What is your credit worthiness? Nowadays, everything became professional. There are some credit rating agencies. They will assess you and they will tell your banker that this fellow is worthy enough this much, you can give him loan. So your rating of your organization also plays a role. Yeah, the classification of the funds, sources of funds, basically are three. Periodic basis we can classify, long-term loan, short-term loan. Or you can, long-term loan could be 5 years, it could be less than 5 years, but more than 1 year, or exactly 1 year. That could be the less than 1 year is short-term, or sometimes it is a working capital. Then ownership base. Who is the person who is giving? Ownership basis means whether your own co-owner is giving you money or outsider is giving money. That also we can classify. Then sources of generation. Is it an internal source or external source? Anything that you raise money within the organization, it is called internal source. Anything that you raise from other than the organization, it is external source. We'll go into the details of this. See, sources of classification, if you make, on the basis of period, on the basis of ownership, on the basis of source generation. There may be overlapping of names because of this one, but classification you should know. For example, long term. If you talk about long term, you can raise equity shares. When you make it equity shares are never paid back. They are only transferred from one owner to another owner, or one equity holder to the another equity holder, but not payable back to the owner. That's called equity shares. Then retained earnings are the earnings of the firm which are not paid to the owners in the form of dividends. Instead of paying to the dividends, we will retain them in the form of reserves. That could be the retained earnings. Then preference shares means within the shares only there are preferential shareholders. The word preference means importance is given to them. Importance is given in what? Number one, while paying the cost of capital, that is dividend. At the time of paying dividend, you cannot pay dividend to the equity shareholder unless you pay to the preferential shareholders. This is called first preference, while paying a part of the profit or dividends that you pay. The second one is, in case the company is closed, winding up, at the time of closure, after paying to the external sources of finance like debentures and loans to the banks, etc., etc., after paying to the outsiders, while paying to the owners, first preference is given to the preferential shareholders. So these are the two preferences or priorities are given to the preferential shareholders. So they are also part of the owners. They too have voting right, but equity shareholders will have a voting right inevitably. Preferential shareholders will have voting right only if they are not paid the dividends in the right time. For the cumulative period in which they are not paid the dividends, they can be participating in the management. Otherwise, they have no role to play in the management. Then you find debentures. The word debentures is a very common word you must have used. Number one, we must understand that it is not a part of equity shareholders. So they will not have any role in the management at any stage unless the firm becomes insolvent and it is taken over by lenders, which is a rare case. Otherwise, no role to play in the management. Debentures are the fixed rate of interest bearing documents. So company issues a document to them mentioning the rate of interest they agreed to be paid. Let us say 10% debentures, 8% debentures, 7% debentures, 6% debentures. You mention it is a prefix. The prefix which you mention is the indicator that irrespective of your profits, every year you need to pay them interest on their debentures. And that interest has to be paid before you pay to any dividends, and it is a charge to the profit and loss account. You can debit the profit and loss account, thereby you can show lesser profit. On the reduced profit only you can pay income tax. So that is called debentures. If you take a loan from financial institutions, there also agreed rate of interest has to be paid and it is also chargeable. Loan from banks is the same case. Then you have a short-term loans. Short-term loan means trade credit. Somebody will supply you material, raw material on credit basis. Normally they give 30 days time or 45 days time depending upon the agreement. Normally 30 days time is given. So it's a short-term period. Factoring. Factoring means you have purchased some goods and after that you manufacture the goods and then sell them to your customers. When you supply to your customers, the customers will be paying you similarly as you are paying 30 days late. they will also pay you 30 days late or 45 days late. Sometimes if you allow, they will pay 3 months late also. So I will not get money till 3 months, but I am in need of money today. So if my rating is good, I can approach factoring agents. They are called factors. So the factoring agent will take my right of collecting money from my customer, will be transferred to the factorer, and factor will take the right to collect on the due date, and he will pay me money full today. But he will charge some service charges. He will take that and then give you. On the due date, he will collect it from customer. In case customer does not pay, he will catch hold of me. This is called factoring. Then you have banks, of course. Banks also will do the same nowadays. On hypothecation, they will do it. Commercial paper. Commercial paper also is almost like a factoring. Commercial paper is you write a promissory note or anything like that, and then transfer the money to the other party. That's a commercial paper. So these are all the ways in which you can pick it up shorter. In between these two, you have medium term loans like loans from bank, public deposits for 3 months, deposits for 6 months. Loan from financial institutions, medium term loans are given by state finance corporations or the development corporations. They will give money, but they will give for 6 months, they will give for 8 months, they will give for 2 months, they will give. Lease financing also, people will give you some assets you can buy and you can pay them in installments. So this is a period based. Same loans, same terminology, but we can classify them under the heading of ownership. If you are giving a part of the ownership, that means you are making them as co-owners with you. We call it as equity, which we have already discussed. Retained earnings, we have already discussed. If you are not giving ownership with them, still you are borrowing from other than owners, then we can call them as debentures, loans, banks, lease finance, commercial. Same terminology, but we can put them under different heading, that is called source of generation. Are you generating within the organization? Internal source. Are you generating other than internal? That is external source. So internal source could be equity share capital and retained earnings. I have already told you that without declaring dividends, you retain. But one danger is here. If you don't declare dividend for a longer period, people will not keep quiet. They will believe that you don't have money, therefore they will dispose of the shares and your market value of the company will fall. Hence, you need to balance them. You need to create a confidence. That is called retained earnings. Whereas external, we have already discussed all these things from outsiders. So this is about the equity shares. I have already given information. You can have a look over these things, and since I will be sharing the PowerPoint to you, you can look into it. Public deposit, I told you that it is a short-term period. Commercial paper, for example, is a short-term unsecured money market instrument issued in the form of a promissory note by a big corporation having excellent credit ratings. As the instrument is not backed by collateral security, only large firms with considerable financial strength can alone issue such instrument. People will not buy otherwise. This I have already told you, supplier will give credit. Factoring I have already explained you to liquidity. Lease finance I have explained you. Term loans from banks and financial institutions. Term loan means a particular term you are giving, and loan which is repayable after a specific term is over. 3 months, 6 months, something like that. Thank you.